Make money in the business, make money at W-2, funnel it into real estate, learn the strategies that allow you to use real estate to offset your W-2 and lower that 32% tax rate that you're paying, okay? This is what most people that I work with do.
Hey guys, welcome back to the podcast. Today I'm going to talk about what I call the financial freedom and the money flow roadmap. And I've never talked about this before, but I did address it in my recent tax strategy boot camp. And if you want to check out the recordings, just stay tuned and we'll see you guys at the end of the episode.
The first thing I want to talk about is this concept called the money flow roadmap. And I've created this, and I can't say that I didn't have help. Has anybody ever read Rich Dad Poor Dad? If you could, reaction and just thumbs up if you have. Anybody's read Rich Dad Poor Dad, by Robert Kiyosaki? Yeah. So he wrote a sequel to that book called Cash Flow Quadrant. And the Cash Flow Quadrant really talks about how exactly you get taxed it looks a little something like this. It's just like this quadrant. And so it's like how you get taxed as an employee versus a self-employed, versus a business owner versus investor. And he talks about how each one of these, because the goal of all of us is to eventually move to just being an investor. We talked about that yesterday. Like some of the richest and wealthiest people in the world literally just invest their money all day long. You know, the Buffetts of the world, Cubans of the world, although Mark Cuban announced that he paid like $280 million in taxes or something crazy like that. But the investors of the world pay the least amount of money in taxes. And so Cash Flow Quadrant by Robert Kiyosaki is talking about how you move your money to become an investor, right? If you're making all your money as an employee, you're going to be paying a lot of taxes. But if you can eventually move into that role of investor, whether you're an investor in other businesses or you're an investor in real estate, like you're going to pay significantly less in taxes. That's you. So I developed my own version of Cash Flow Quadrant. And again, I didn't steal it from him, but I took a lot of concepts from it. And so instead I call it the money flow. I call it the money flow roadmap. So it looks a little something like this. It's kind of the same little quadrant, except we have to understand that there's four buckets of income, really. Four different categories of income. So this top left bucket should be what everybody's familiar with. It's called earned. Okay. Earned income. By the way, if you own a business or own a rental property, you're part of the 7% of people that will ever own a business or a rental property. So give yourself a pat on the back for that, because 93% of people that live on earth will never ever own a business or a rental property. And that's something to be proud about. But earned income, this is going to be like income at your W-2. If you're a 1099, if you're a business owner, this is what's called earned income. And the problem with earned income is there's not a lot of stuff you can do to offset earned income. We talked a little bit yesterday about, what can you do? You got 401ks, you got HSAs, and you can have more kids. That's really about it if you're just a W-2 employee on like what you can do to save money on taxes. On top of that, earned income also has what's called that FICA tax. Right? So if you guys go look at your recent pay stub, you guys got paid yesterday, if you're a W-2, you'll see a line that says Social Security and you'll see a line that says Medicare. And remember that makes up 7.65%. That's 7.65% in taxes in addition to what you're paying on this if you're a W-2 employee, and then it's 15% if you're self-employed. And we're going to talk about a strategy later on to mitigate that 15%. But long story short, earned income, and again, the highest tax rate you're paying could be that 37% federal. So I'll just use an example, like my example. So let's say I'm in a 32% federal tax bracket, but on top of that, I have to pay this 7.65%. So I'm really looking at close to 40% in taxes on any money that I make at a W-2 at an earned job. Okay. Now this is one of the four buckets. The next bucket that a lot of people here go to right away is the passive bucket. Okay. The passive bucket is going to include long-term rentals, short-term rentals. You might have multifamily in there. Any sort of rental real estate. Could be campgrounds, could be whatever you're renting out, hotels, RV parks, etc. Right? A lot of investors move to that. They take their earned income and they dump it right into passive, which is great. Don't get me wrong. This is a great way to build wealth. Take all your W-2 or take your earned income, move it into passive. Because why? Well, remember we talked about yesterday that passive income doesn't have the 7.65% tax, right? So right away you're getting a pay raise by having rental income as opposed to earned income. And then also remember you can use losses from one property to offset the gains or income of another property. So I might have income on my long-term rental and short-term rental, but I might have a loss on my multifamily, and that loss can be used to offset the other property. So I used to say something like it used to be like robbing Peter to pay Paul, because you could have some properties that you're buying and then they start cash flowing really well. Well, now you got cash flow. So you want to redeploy that into more assets so you could save more money in taxes. Now, with the passive income, with this, you're going to have losses, right? And we talked earlier, they're not like real cash flow losses most of the time, but these are instead paper losses that you can use. Now, our firm specializes in helping investors use those losses that they have at the end of the day to offset their high W-2 income or their high business income. So make money in the business, make money at W-2, funnel it into real estate, learn the strategies that allow you to use real estate, like we talked about yesterday, real estate professional status, short-term rental loophole, some of the other methods to use. We're going to learn about the midterm rental loophole today, but take your W-2 money, or your 1099 money, funnel it into real estate, use the losses from the real estate to offset your W-2 and lower that 32% tax rate that you're paying. Okay. This is what most people that I work with do. And I don't want to say that this is not wrong by any means. I think what investors are missing is that lull, is the bridge between, okay, I'm stockpiling a bunch of money at my W-2 or my business, and I'm waiting for that next rental property. Well, hey, like rates have shot up since I bought my first property, and I don't really want to invest anymore. Well, now I have that money sitting in like cash, CDs, or I have it sitting in treasuries, and it's not earning that much money compared to inflation. That's where a concept, and I'm going to talk a little bit about it, is called portfolio income. So if anybody's done the one-on-one strategy call with me, you might have had me tell you about portfolio, the portfolio. This is terrible. The portfolio tax bucket. So portfolio income is like stocks, bonds. You might have interest income, right? So you might have interest income on bonds that you own. What's great about portfolio income, and this is really through what I call a taxable brokerage account. So on that net worth statement, you'll see something called a taxable brokerage account. This account is the number one least utilized account for real estate investors. Why? Because it really serves as a bridge between earning money at your W-2 or your 1099 and dumping it into real estate. Because where are you parking that money for an extended period of time? A lot of people are just sitting in cash. I would rather have it invested, earning a modest return and outpacing inflation, and just earn you a little bit of money that's liquid. So remember yesterday we talked about with the taxable brokerage account, if I have capital gains, so let's say I have money that's held in there longer than a year. Well, I get capital gains treatment, right? So that's going to be either 0, 15, or 20% based on how much money I make. most people pay 15% capital gains tax. So if I have money sitting in cash, it's not going to earn anything. In fact, I'm going to lose money to inflation. But if I have it sitting in this taxable brokerage account, maybe it's earning 5-6%, and then I just have to pay taxes on that 15%. But what's really cool about this account is the nature of how all this income is taxed. Because right away, and I know I'm getting sloppy with this, but this 7.65% in that Social Security and Medicare, remember how we don't have to pay it in real estate? Well, we also don't have to pay Social Security and Medicare tax if we have a taxable brokerage account or in our portfolio income. So this is the number one least utilized account for real estate investors. You can borrow against this account as it goes up in value. You can do what's called tax loss harvesting. So maybe you have some stocks that are at gains. Maybe you have some that are at losses, and you can use those to offset each other. But the main thing, though, is remember the max that I'm going to pay in this taxable brokerage account is 15% taxes. So check this out. Like, I'm earning money at my W-2 job, and we already said this, I'm paying 32%. That money is getting funneled into the taxable brokerage account. Now the earnings on that money is only getting taxed at 15%. So I'm cutting my tax bill in half there. Actually, more than half, right? Because I was 40% over here. Now I'm 15% here. And then eventually this money is waiting for a real estate deal where I'm going to eventually pay 0% in taxes, right? So I go from 32, hold that money in the taxable brokerage down to 15, and then to 0% tax when I put it in real estate. Where do you open up a taxable brokerage account? You can do Vanguard, Charles Schwab, TD Ameritrade, Merrill Lynch. I don't have any preferences. I don't make any money by telling you guys to do that. It's just something that I've seen that a lot of real estate investors don't utilize. And another pro of this account is the liquidity. In this account, like if it's Monday or Tuesday and you're like, hey, this deal just came up, I need earnest money by Friday, or I need to lock into this deal, you have access to the money like that. That's also one of the downsides to the account, because if it goes up or down, you might be like wanting to sell part of it. But just be disciplined enough to, okay, I'm going to earn money at 32%, 40% with the Social Security and Medicare tax. I'm going to park that money in the taxable brokerage account. The most I'm going to pay, assuming that it's long-term capital gains, the most I'm going to pay is 15% in taxes. And then I'm going to 15 or 20%, right? And then I'm going to funnel it into passive income through real estate, where I'm going to be eventually paying 0%. The other bucket here, notice I have a fourth bucket. Okay, so we're going from W-2 to taxable brokerage to passive to real estate, right? Everybody understands that? Going from 40 to 15 or 20 down to 0. That's the goal, right? The other bucket is, I'm gonna split this in half, because Nate talked a little bit about this yesterday, is Roth versus traditional. Okay, traditional 401k, traditional IRA versus Roth 401k, Roth IRA. What's the difference? Well, remember, we said when you're in years of high taxable income, you're in that 32, 35, 37% tax bracket. Maybe you do want to contribute to traditional. But when you're in years where your tax bracket's low, we really want you in Roth. Okay. Well, when can your tax bracket be low? Maybe you got married. Unfortunately, maybe a spouse lost a job. Maybe you bought a bunch of real estate and you're able to lower your taxable income, and then we can have you contribute or do Roth conversions. But here's the name of the game is, if 15, 20 years from now, when you go to retire, or whenever you go to retire, if all the money that you're pulling out for retirement is in these three buckets, again, I'm sorry, I'm drawing over myself here. If all the money that you pull out when you're in retirement is in these three buckets, portfolio, passive, or Roth, I hate to say this, but you can almost manipulate what you want your tax rate to be that year. Let me show you exactly how, because remember, with portfolio, it's determined by me. Like, yeah, I'm going to get some dividends. I might get some interest on some investments, but I get to choose when I buy and sell that stock, right? And so I get to determine when I have that capital gain. Roth income is going to be the same thing. Roth income, I'm going to be able to decide when I want to pull that money out or not. And the greatest part about Roth is it's tax free, and it doesn't add to your tax bracket. Okay, so check this out. Like if let's say I'm retired, and the only thing I have is pension income, and I got a $200,000 pension. Okay, well that's going to shoot my tax bracket if I'm single all the way up to 35%, even when I'm in retirement age. Okay. But if instead, let's say I have a $200,000 income stream in retirement, but I might have 75,000 coming from Roth. Okay. Which doesn't add to my tax bracket. Okay. When you pull out money with Roth IRA or Roth 401k, it doesn't add to your tax bracket. I might have another, let's say 75,000 of rental income. And remember, rental, as long as I'm redeploying that cash, I'm not going to owe taxes on my rental income. So 0% tax here, 0% tax here. And then lastly, guess what about capital gains, guys? If you're married, and this is current law. If you're married and you make less than $120,000 a year, you can withdraw up to $120,000 of capital gains completely tax free. Okay. And how does this work? Well, if I have $200,000 pension, that's earned income. So if I have capital gains on top of that, I'm paying that 15 or 20%. But over here in this scenario, remember Roth. Oh, sorry. There we go. Can everybody see it now? The buckets? Okay.
Yes.
So on the scenario on the left, I might have a $75,000 income stream of Roth that doesn't add to my tax bracket. I might have a $75,000 income stream on rental property that doesn't add to my tax bracket because it's being shielded by depreciation and other expenses. And then I get to withdraw that $50,000, let's say. Actually, I could withdraw up to $120,000 of capital gains completely tax free. So I'm drawing $120,000 of cap gains. I'm getting $75K of rental income, and I'm getting $75,000 from my Roth. That's a total of $270,000 in retirement, and it's all 100% tax free. Literally tax free, $270,000 of income per year in this scenario. Because look at, man, this is some chicken strats right here. Because I'm taking money from these three buckets: passive, portfolio, and Roth. Okay. So what I mean by withdrawing capital gains. So let's say for example, I have $500,000 in my taxable brokerage account. That's what I contributed to it. And then the taxable brokerage account over the course of time, let's say that 500K goes up to $1 million. Okay. Well, if I sell $120,000 worth of gains, so maybe I pull out 60,000 of contributions, and then I pull out the $120,000 of gain, and so I'm pulling out a total of 180. But remember, you don't get taxed on the money that you put into that account. So this 60,000 that's considered contributions, you don't pay taxes on that. You only pay taxes on the gain part. And if I'm below those tax rates, I'll show you the tax rates in a second. But for 2024, if you're married, you can have up to $120,000 of capital gains completely tax free if that's your only taxable income source. And going back to this, if I only have Roth and rental properties, well, the capital gains my only real income source because these other two are tax-free income streams, right? So Andrew asked, what is invested in this taxable brokerage account you are talking about? So this is a good question. So I like to use, I actually have a Vanguard index fund that tracks the federal government pretty much. So it earns like a 5.5% return, and it's a pretty stable and like risk-free return because it's investing in like government debt. I can get you, if you want to message me, I can get you the sticker or the ticker name. But yeah, you would most likely invest your taxable brokerage account in a combination of like money market or these low cost index funds. So that way they're earning capital gains for you, as opposed to just sitting in a CD or a cash and it's earning interest income, because interest income is actually taxed at your normal tax rate. Versus if you have taxable brokerage gains, like capital gains, those are taxed at that 0, 15, or 20%. So any other questions on this? I know I kind of went by that pretty fast. Confused as to how rental income is no tax. Well, so you're going to have on your rentals, you're going to have expenses and depreciation for your rental properties most of the time. And so that's how you're able to hit $75,000 a year of cash flow that hits your bank account. But what hits your bank account isn't what you're paying taxes on, because you have all these deductions like mortgage interest, taxes, insurance, depreciation, all the other expenses. So it's not uncommon. Like I had a client this year that had like a $250,000 of cash flow, but after all her depreciation, she didn't pay any taxes on the $250,000 of income. Are you saying take your cash that's left over after your W-2 and immediately put it into your brokerage account? I don't think it's everything, but I would say like have a 6-month emergency fund first. So take whatever you spend per month on living and multiply that by 6. I would have that just sitting in a cash, like high yield savings, or sit that in cash. And then anything that's left over that, I would put it inside of a taxable brokerage account while you're waiting for your next real estate deal. Even though my CDs might be 5%, it gets taxed at ordinary income, where if I get 5% capital gains, it is a lower tax rate. Yeah, exactly. So 5% in a CD, that's ordinary income. You know, for me, that'd be 35% tax rate, versus if I'm going to hold on to that for at least a year, I want to get capital gains. So that way I only pay 20% as opposed to 35%. I'm saving myself an extra 15%. Again, assuming that I'm holding on to that money for at least a year. Okay. I don't know if I'll have time to get into the financial freedom roadmap right now. I do want to, maybe I'll earmark it and get into it later. I know this was a lot to take in for a second, but just to summarize this again, we have earned income, we got portfolio, we got passive, and we got retirement. So either, I'll draw a line in the sand here, either Roth or traditional. So moving money from the brokerage account to especially if you're working a full-time W-2, it's not likely that you can move your brokerage money to real estate tax-free. But remember, anything that's earning in the brokerage account, you're likely paying 15% in taxes. But then once that money gets funneled into real estate, then you're down to 0% tax. Now, we've had clients where if let's say they sold like Amazon stock or company stock, or maybe they had shares from a previous company, they have a huge capital gain, and then they take that and they deploy it into real estate. You can actually use the real estate losses to offset the gain on the brokerage account stock sale. I think there's somebody in here that signed up that had, that you, Sushi, I think, or I can't remember. Somebody sold stock at a huge gain. I don't know if they're in here right now. But yeah, if you had stock gains, and you sold that stock and you took that money and you invested it into real estate and you qualify, you can use the losses from the real estate that you bought to offset your stock gains.
And if you enjoyed the podcast today, just click on the link below in the show notes and you'll be one of the first to know the next time that I do a tax strategy bootcamp.